and it's time for Ask Annex. Got a question? You head to our website, annexwealth.com. Look for the Ask tab. In the studio, Matt Morzy, Investment Team Manager. Welcome.
Hey, Danny.
And we got Fred Coleman, a CFP and a Wealth Manager at Annex Wealth Management. Welcome to you.
Thanks, Danny.
Question number 1. What is the latest on the 60/40 portfolio? If my time horizon is 15 years, should I care?
We're 15 years out. No, I don't really think you should. That's quite a long time, when you're thinking about from an investment point of view. At this point, what I think you should be more concerned about is how much are you saving and what's the placement of those savings? Is it a traditional IRA, Roth IRA, taxable account? Those are the things that I would care about more, is getting money into the market. Frankly, with 15 years out, you're probably rooting for a flat market for a little while so you could get as much money invested as possible at current prices, or maybe even a large pullback in the market so that you could dollar cost average into lower prices for a rally then to boost your overall return over those course of the 15 years. Thinking specifically about the 60/40 portfolio, that 40% of it, that bond part of it, has really been beaten up over the last couple of years. Frankly, that bond bear market that we're in, is longer than some of the big stock market pullbacks that we've seen as well lately too. So it's really uncomfortable for people. In fact, we were just talking to clients recently about this, just about how that feels different from a bond pullback than it does a stock market pullback. But one thing to see that from a fixed income standpoint is that now that yields are going up, that's going to increase your overall rate of return going forward for fixed income. When you think of 10 years and out, that starting yield that you're getting on it is going to be the best indicator of what you're going to get going forward on that. So for 15 years out, I think you're in a pretty good spot.
Yeah, and you may be reacting to last year because that was one of the worst years since 2008. But this really is also a matter of what your risk tolerance is. At Annex, we take each of our clients through a personalized risk assessment. The risk assessment tells you the investment return for our portfolios and what you can expect for the next 6 months. So we'll give you a high point, a low point. Usually everybody's okay with that high point, but if that low point is uncomfortable for you, then maybe the portfolio is too aggressive.
Question 2 on Ask Annex. Do I really need to understand a company's core business if the fundamentals look solid?
Yeah, it's a good question. Fred, why don't you start us off on this one?
Yeah, fundamentals are very important, especially when it comes to determining the value of a stock price. And understanding a core business is a part of that process. Each security that you own should play a specific role in your portfolio and complement the other positions that you own. But not only should you look at the numbers, you should also look at the subjective side of the business. How does the company make money? What are their competitive advantages? How good is the management team? And what are risks to the business? But these are all things that the balance sheet doesn't necessarily tell you, but are very important to understand.
Yeah, knowing that core part of that business is going to let you know how repeatable those fundamentals are. If it's something that's sustainable over long time periods, that they have a wide moat around what their core business is, that they do what they do better than other companies, and that they're in a business cycle that's going to be repeatable for them, is going to tell you a lot. Fundamentals tell you something that's a flash in time right now, or maybe over the last 12 months, or maybe you could pull that out a little bit further and look at some time series on that, but understanding what they do each and every single day, and is that repeatable for that company going forward? And then again, what threats are they going to see in terms of other companies trying to do that as well? But you really want to understand what that company does.
This is Ask Annex. Got a question for us? You head to our website, annexwealth.com. Look for the Ask tab. Don't have to be a client. We want to hear everybody's question. Next one. Should I count my employer's contribution to my retirement plan as part of a 15% retirement savings goal?
Yeah, one thing to keep in mind anytime we throw out those numbers, that 15%, that's a broad recommendation. For a lot of people, 15% will be more than enough, even if you do include your employer match. But there are a lot of other factors to consider. What age do you want to retire? How much do you plan on spending? What will your tax rate be? When will you take Social Security? When we run financial plans, we take all those things into consideration, and you'd be surprised how much you'd earn extra at the end just by saving a couple extra percent out of your check. It can make a significant difference in your nest egg. So if you can do 15 on your own, then anything the employer contributes on top of that is just a bonus. I've never heard of someone saying they had too much in retirement.
Yeah, that's for sure. I think that's what's really powerful about how we work with clients and the software that we use as well, too, because you can have an idea of where you're going to be at different points of time, and you can play with those numbers to achieve what goals you have specifically. I just think from a general standpoint is I wouldn't count it, just if I'm just going to try to look at just broad numbers, because like you said, no one complains about having too much later on, but it's also a battle of, okay, what do I have today? What do I want to defer to the future? I would use that as the cherry on top of that ice cream sundae in terms of your savings goals long term. But ultimately, it's going to be very specific to you. And I think that's so powerful what we do with clients in that way.
Run the score up a little bit, right?
Oh, for sure.
There you go. Matt Morzy, Investment Team Manager. Thanks.
Thank you.
Fred Coleman, CFP Wealth Manager at Annex Wealth Management. Thank you.
Thank you, Danny.